Hello, everyone, and welcome to another Cats and Co podcast. Bitcoin has had a sharp correction recently, and of course, there are loads of explanations floating around as to why. Some get repeated endlessly, and some simply don't tell the full story once you dig into the details. So, in this video, I want to give you three things: the mainstream narratives you've probably heard and why those narratives are probably alone not enough to fully explain the speed and the violence of the move. And also the catalyst that I think actually fits in with the timing and the pattern, and also why this type of crash often leads to a very fast V shaped recovery. So, before I start, I just want to give a shout out to a Twitter user, Marty Party, who kind of brought this to my attention through one of his posts on Twitter, and I have, of course, put his details in the description below. So, the first explanation that people go to is really regarding the ETF outflows. And yes, we did see record outflows in November, almost $4 billion, but that was gradual and visible pressure, not the kind of overnight hammer that triggers a 30% vertical cascade that we saw. The second narrative is, of course, the macro fear. And there was a genuine risk off in equities and there was a hawkish Fed tone, but the other assets didn't get anywhere near this wrecked as Bitcoin did. And the sharpest legs down still don't line up perfectly with the macro headlines. So that certainly doesn't seem to fully explain things. Narrative three is minor capitulation. Post halving, margins, of course, are brutal. And yes, miners dumped around 30,000 Bitcoin in a matter of days. But again, that is visible supply pressure, not hidden urgent selling that usually sparks these kind of waterfall moves that we saw. And the fourth explanation is whale manipulation, except that the biggest whale cohorts were actually net buyers on the dip, not sellers. So that doesn't fit either. So while the first three explanations did add some fuel, none of them on their own explain the sudden vertical nature of the drop. So what did? Well, a crash like this usually requires a big, urgent one-off seller that nobody sees coming. And that's where I think it gets interesting. As many of you will know, recently the US Department of Justice seized around 150,000 Bitcoin from a major Southeast Asian criminal network who were running large scale online fraud operations. This was one of the largest Bitcoin seizures in history. And I think that seizure set off a chain reaction. Sanctions from the US Treasury, raids and freezes in Cambodia, in Hong Kong, in Taiwan, in Laos, and Singapore, shutdowns of the physical scam compounds themselves, and huge amounts of illicit assets being frozen. And these networks were not small. They held enormous Bitcoin reserves as part of their operations. So, when the biggest group lost their entire stash overnight, the rest panicked. They knew they might be next, and what do criminal networks do when they fear a raid? They liquidate. And in this case, they liquidated everything instantly through the OTC desks in Phnom Penh, in Bangkok, in Dubai, in fact, anywhere that they could turn Bitcoin into cash fast. This kind of selling doesn't show up on exchanges or in ETF flow data, but it will absolutely hit the price. It looks like that forced invisible selling was the most likely spark to set this whole thing off. Then the visible pressures, ETF outflows, miner selling, leverage liquidations, they amplified it into the full cascade downwards that we saw. And here's the really important point. Forced sellers only sell once. When they're done, they're done. And that actually sets the stage for something very positive, hopefully a V-shaped recovery. Crashes caused by forced liquidation, not macro fear or structural selling, often rebound incredibly quickly. This happened with Plus Token in 2019, the China mining ban 2021, and the lunar collapse in 2022. In all cases, violent drops followed by strong recovery. Why? Because after the forced selling, The biggest sellers are gone. Supply dries up, liquidity normalizes, shorts get squeezed, long term holders step in. If this explanation is right, then the cause of the crash is already done, over. It's not an ongoing structural problem, and that's exactly the setup Bitcoin has historically snapped back from in the past, often sharply. So that's why the usual explanations don't fully fit, and why the global crackdown narrative does, and more importantly, why this type of crash often leads to a fast V-shaped recovery rather than a long bear market. So, if you found that useful, hit like and subscribe and leave your thoughts in the comments below. Thanks for watching, and I will see you on the next one.